I think it's in a very strong state, simply because the European economies are doing well. The consolidation opportunities, which always help to drive returns in European private equity, are still there and still available, much more so than they are in the United States or in Asia for that matter. So that's the positive. I think the challenges include the level of valuations that we're currently seeing, which are only sustainable if people have a clear game plan as to how they intend to deliver alpha and drive the EBITDA of those businesses. The financial engineering, or financial mechanics as I call it, that we saw leading up to the last financial crisis, or the global financial crisis, are not going to be there to deliver the sorts of returns that are expected from limited partners these days. So we have to continue to work, as we are doing, very hard to drive EBITDA growth in those businesses, because that's where the bulk of returns will come from. But it is against a backdrop of challenging valuations, so we have to be very careful. I think just playing the market is a dangerous game right now. But there are some very smart people in the industry with some very deep sectoral knowledge, both in sectors and in subsectors. And so they will continue to focus their activities on those areas where they believe they have an edge. I think it certainly is a challenge. I think the uncertainty that was created by the vote sort of 2 years ago now has not really been addressed by the politicians adequately on either side, and we're leaving it very much to the last minute, which causes a considerable amount of uncertainty. And we've seen quite recently in the press, particularly in the UK, that uncertainty translate into statements being made by leading employers, leading industrial companies, leading manufacturers present in the UK about the challenges that that's causing for them in terms of their long-term financial planning, and the threat, if you like, that they may have to leave the UK in order to avoid issues with supply chain and having spare parts, for example, stopped at the border, because we still don't have clarity in terms of the customs union, what role Britain will play in the customs union going forward. And that, for a businessman, is a very difficult situation to cope with. How does that translate into private equity? Well, it throws up all of those same questions in terms of what is the 5-year plan for that business, which is the typical length of ownership for private equity, as you know, and how we're going to cope with that in the context of driving value. Add to that the uncertainty around sterling, which is, as you know, has depreciated since the vote and could well, in the eyes of the IMF at least, be due for a further depreciation in the coming weeks, months and years. Then that means when we translate those returns out of sterling into either euros or US dollars, the returns will not be acceptable in those currencies. And therefore, we've got to be very careful and very specific in terms of what we target in terms of UK investments. Yes, diversity is a real challenge for the private equity industry, as it is for many industries. But in particular, because we tend not to hire at senior level, we tend to hire at more junior level and allow people to progress through the ranks. It's absolutely vital that we start to attract, retain and develop female investment professionals. We can't just allow the support services to give us that sort of balancing to try and achieve more of a 50-50 between male and female employees. We have to consciously target attracting top female talent into the investment professional pool so that they can then develop with the firm and become the future partners of the firm. I think that's absolutely vital. It's vital in the sense of when we're assessing companies, whether they be consumer brands, whether they be industrial companies, makes no difference. We need that female perspective, and we need high caliber female participants to have a full debate. And if that is too slanted towards a male-only population, whether it's in the corporate boardroom or in the private equity investment committee, that is suboptimal, and we need to therefore take measures to address that. There are organisations such as Level 20 based in London that are seeking to do that as we speak, but within each firm that's present in the private equity market, we need to start pushing that further up the agenda, making it more of a priority and giving it more of the importance which it deserves. The benefit of co-investment for the larger pension players is really twofold. It means that they can hope to deploy additional amounts of capital. It means they can choose specifically which transactions within a fund they find most attractive. And so arguably, if they are good at their job, then they can outperform the overall fund if they choose the top decile investments within each individual fund. So it's both a deployment of capital and, if you like, an amelioration of the performance of the investments of that particular investor. The second area, which I guess is equally important, is the trend is to essentially pay less in terms of management fees and carried interest on co-investments compared to the full freight which is paid on the actual fund itself. And therefore, that's a means by which the overall blended rate of management fee and carried interest can be decreased for the benefit of the investor. And so we're starting to see that come through more and more, and the population of investors who are seeking to pursue co-investment opportunities is continuing increasing. That said, co-investment is not that easy, and so you again have to attract, retain and develop the right talent within the investor in order for them to be able to keep up to speed with the private equity fund that is consummating the transaction. If at any time that co-investment starts to slow you down, makes you less competitive in a market like this, then you'll miss out on opportunities. So it's important that you're accepting co-investment, but from those people who are in a position to actively co-invest at the same speed as the private equity fund. Absolutely, yeah. I think it's here to stay. I think it's an important part of how we do business now, and I think it's something that we need to sort of continue to embrace. And I think generally we need to continue to have a positive and fluid dialogue with our investors, so that leaving aside KYC from a regulatory point of view, we need to know what our customers are looking for and try to address that. I think co-investment is one of them. That will continue. I think people will keep an eye on the markets because the fundraising environment is positive right now. We've seen in the past that can change very quickly if sentiment changes, and so that's something to keep an eye on. And then the sort of the trending aspect, which everybody has a close eye on, is valuations and where those are getting to, and people starting to factor in M&A, etc. It's sort of, you have to assume then that everything goes well, and in the real world we all know from experience that not everything is going to go the way you hope it goes. So you have to have a more balanced view and not stretch at the entry multiple level, otherwise that will adversely impact your returns in the longer run.